Hello everyone, and we're out in the park today, and there's lots of people out doing very energetic things, and life goes on as normal as global stock markets completely crash. Look, I mean, it's not something to be flippant about. This could be a very significant medium-term shift in what equity markets and asset markets are doing, and of course volatility is always a two-edged sword. It's difficult sometimes to stay with positions you want to stay with, and other times it's just not going away, but it's always an opportunity. Remember, markets are the hardest way to make an easy living, which is the reason why if you manage your portfolio very actively and carefully, prudentially, you can do extremely well and you can build long-term wealth. But again, I'm coming back to something I've alluded to before, which is in suggesting things as I did in the written report today that we could be, and in that very special major report video I did 2 days ago, it's not about, you know, being a doomsayer. It's about saying what's going to happen. For instance, at the moment, there's been a bit of sunshine and there's some storm clouds coming across the ocean. But it wouldn't be wise of me to say everything's fine. And that's all I'm doing in these forecasts. And it's really a situation of, look, I could be wrong, but this is actually a very personal message to everyone. Please just stop and consider if even some 10 to 20% of what I'm suggesting might be valid, and perhaps you should incorporate in your portfolio construction going forward. Again, I would highlight to you that the ultimate hedge is going to end up being gold. It is the US dollar at the moment. That is the flavor of the month, global hedge. But in the long term, that could shift from the US dollar to gold. What's really interesting about the price action in the last 24 hours, and remember I said this would be a sign that it was time to buy gold again, and it is happening. That is, the US dollar was firm, the euro was the weakest, it fell rather sharply, remember we said it would, and gold managed to actually rally. So gold rallied as the euro fell and the US dollar strengthened. That's a very positive sign. It doesn't mean it's really easy now. We go and buy gold today and we make an enormous amount of money straight away. It could be we buy gold today and it goes down a little bit again. But overall, on a near to medium term basis, that price action is very encouraging for the idea that gold remains the ultimate safe haven hedge against both delta and inflation and uncertainty, just simple uncertainty. And that's certainly, there's a flood of uncertainty around financial markets at the moment. As I mentioned in that written report, China went into manufacturing contraction yesterday. Japan, second month of industrial production contraction. United States is looking, it's well and truly rolled over, the United States economy. I don't know why people are still talking about it as if it's a very strong economy. It's obviously not. It is good that they managed to pass the debt ceiling bill, which just means it's okay to have even bigger debt. So I'm not sure it's a clear positive, but it means government can continue to function. Of course, that's good. The big hoo-ha about the infrastructure bill, well, the infrastructure bill will be great, but again, it's just the United States attempting to partially catch up to the rest of the world. As I heard a US economist say in the last 24 hours, if you've traveled anywhere else in the world, you fast get an idea of how old our infrastructure is. So the United States has a lot of catching up to do on a lot of fronts, and we all know that. No country's perfect. But just remember, this infrastructure bill is just that, and it's not going to put the United States ahead of the world really in any shape or form, I don't think, at this point. The US remains the world's largest economy, China remains the world's second largest economy, but if you take all of the European Union together, it's actually bigger than the United States. So 3 equal superpowers moving forward. We've talked about the currency implications of that for a decade. On the day, what I'm suggesting to you, and really the most valuable insight and information I could give to you, is that this is not just an aberrant equity market sell-off that will immediately bounce back and everything will be okay. This is an equity market sell-off that is in tune with the fundamentals of our time. It isn't a sudden knee-jerk reaction to a pandemic as it was in 2019. It's a building, forced response to slowing economic scenarios in most of the world, and particularly in the two biggest economies in the world, the United States and China. So, you know, in my written piece, I said in 1929, or in 1920, will I go through it all? Please read the written piece. Okay, I'll say it really quickly. In 1920, the radio came out, it transformed marketing. All of a sudden, all little businesses could have national reach, and it changed everything, how business was done. You had the Roaring Twenties, where everyone borrowed to buy stocks, which was self-fulfilling, driving force prophecy to the upside, until everyone who could borrow had borrowed and bought. And then we had slowing manufacturing, which is why I'm talking about that China and Japan data a lot, slowing manufacturing, rising unemployment. And we saw US new jobless claims yesterday. We've had weeks now of where they're climbing. And remember, where they're climbing from was still, after all of the pandemic, new jobless claims had only fallen back to be still 70% above where they were. This is pre-COVID, 70% people still losing their jobs when everyone said the economy was strong. And now the number of people losing jobs is going up again on a weekly basis, and has been for several weeks. So, declining manufacturing, rising unemployment, and after a similar technological breakthrough that's run for 10 years. Now in the 1920s, the Dow Jones quadrupled, right? The NASDAQ, since the 2009 sell-off, has gone up a multiple of 16. It's gone up a multiple of 3 just since last year's low. Everyone thought the radio brought in a new era. Everyone got excited, and it did. And it excited and went with it. Internet brought in new tech stocks, brought in a new era. Everyone's got excited and gone with it. Market's always correct, even if all the news is good. And it's hard to find good news at the moment. So a correction in price on top of weakening fundamentals that the market as the whole isn't really aware of, that's something we have to pay attention to. So, still think the US dollar is going to be strong, still like buying gold, and still think you should be using various financial markets tools to hedge your portfolio to some degree of your choice against a possible further decline in equity markets. Now, I'm not saying any of these numbers are going to happen, but just to give it kind of perspective, in 1929, from that high, the Dow Jones fell 82% and triggered a depression. I'm not saying that's going to happen this time. It's not my forecast at all. It's not even a risk scenario. But in 1987, I witnessed trading. Actually, October 87 was my best month ever, but I probably shouldn't say that. The Australian stock market fell 50% in about 3 days. The US market fell about 30%, I think it was, from memory. Now, in 2007, 2008, we know we had a sustained sort of 18-month, 2-year sell-off in stocks. Last year, in 2020, this is only 1 year ago, we had a 40% correction in the equity market. So if people are saying, oh, this is the correction we need to have, as if it'll be a sneeze, a correction we need to have is something you have when a market's overheated but the economy is still strong. That's not what we have in global equity markets at the moment. In Australia, we have a recession that could be 3 quarters. It might only be 1 quarter, the 3rd quarter, but the 4th quarter won't be strong and the 1st quarter won't be strong. And it is a risk that Q3, Q4 will be a recession. So we're having, as I said, price action downside in that environment. And the 40% sell-off last year was a panic response to, oh, we're all going into lockdown around the world, panic, panic, panic. Then an artificially generated massive equity market rally by all the zero interest rates, all the quantitative easing all around the world, and massive stimulus measures. So, boom, an artificial equity market rally. It doesn't mean the market shouldn't have rallied to some degree. I do feel it's rallied too high. So for instance, a company like Tesla, Apple, I love those companies. They're great. They have a great long-term investment profile. Absolutely. Are they too high at the moment? Maybe. That's worth considering. So I hope you enjoy your weekend. Over where I am, it's a long weekend, so I'm looking forward to that. But just keep in mind that things change quickly, such as our Premier resigned today. She did a great job. She didn't get everything right, and there's an inquiry now about some matters. But you know, a lot of people were talking about it, but it just happened. And the same sort of thing can happen with the equity market. A lot of people are starting to talk about the possibility of a correction, and it might just happen. I guess I've said what my point is, but can I just end with this? It can happen a lot faster than anyone, and to a greater degree than anyone is currently thinking. And I really just, on a personal level, want to suggest to you, just take a second look here and be a little bit careful, or be really aggressive about hedging tools. All right, thank you very much. Look, I really do hope you have a great rest of day, long weekend for some, the weekend for others. And remember, happiness is a choice. So no matter what's going on, you can still choose to be happy. So do stay optimistic about whatever your situation is. And for a lot of us, it's starting to look good with a lot of light at the end of the tunnel, at least in terms of lockdowns. And in financial markets, any downturn could be a great opportunity to be a very powerful investor going forward in the long term. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities. Look forward to speaking to you next.